Welcome to CoreLogic's housing market update for June 2021, brought to you by onthehouse.com.au. Housing markets around Australia continued to surge last month, with CoreLogic's National Home Value Index up 2.2%. The rise in May was a stronger result compared with the 1.8% lift in April, but weaker than the 32-year high recorded in March when values surged 2.8%. Growth conditions remain broad-based, with home values up by more than 1% across every capital city over the month, with both house and unit values lifting across the board. Of the 334 sub-regions analysed by CoreLogic, 97% of them have recorded a lift in housing values over the past 3 months. Such a synchronised upswing is an absolute rarity across Australia's diverse array of housing markets. Across the capital cities, the monthly change in dwelling values ranged from a 1.1% rise in Perth through to a 3.2% jump in Hobart. Across the non-capital city regions, conditions were more diverse. Regional New South Wales led with monthly gains of a 2.5% increase, while values in regional Western Australia had the weakest result, dipping by 0.1 of a percentage point. Despite the consistently strong headline results, the underlying trends have shifted over the past year. The most expensive end of the marketplace is now driving the highest rate of price appreciation across most of the capital cities, whereas early in the growth cycle, it was the most affordable end of the market that was the strongest. From a geographic perspective, it's the smaller capital cities that led the housing market out of the COVID slump, but now Sydney has risen through the ranks to record the largest capital gain over the past 3 months, with values up 9.3%. Another trend that is changing is the stronger performance across the regional areas of Australia. While regional markets led the early stages of the latest growth phase, the performance gap has narrowed substantially between the capitals and the regional areas. For the second time in 3 months, growth conditions in the capital city home values have outpaced the regional markets. The combined capital city index rose by 2.3% in May compared with a 2.0% rise across the combined regional areas. Although housing values are now rising the fastest once again in Sydney, at least in trend terms, the annual growth rate is generally higher across the smaller capitals, as well as regional New South Wales and regional Tasmania. Darwin cracked the 20% annual growth barrier in May, with values now 20.3% higher over the past 12 months. For Darwin dwellings, this is the strongest annual gain on record. Housing values across regional New South Wales are up 18.6%, while in regional Tasmania, values are 18.1% higher. At the other end of the spectrum, the weakest housing markets over the past year have been in regional Western Australia, where values were flat, and also in Melbourne, with a 5% lift in values. In Melbourne, the extended lockdown has created a more significant drag on the annual growth rate. Low advertised housing supply remains a key factor in the housing market due to proportionally high demand. Fresh listings added to the housing market have picked up over recent months, with the number of new listings tracking 15% above the 5-year average. Despite the increase in newly advertised residential properties, sales activity has also increased. CoreLogic estimates sales activity over the 3 months to May was tracking about 37% higher than the 5-year average. The sales to new listings ratio remains around 1.1, meaning for every new listing, there's more than one sale occurring. This rapid rate of absorption is keeping advertised inventory levels extremely low, despite the rise in new listings. As a consequence, vendors remain in a strong selling position, while buyers have a relatively weak position at the negotiation table. With housing sales activity continuing to outpace the number of new listings added to the market, the total number of homes advertised for sale remains approximately 24% below the 5-year average. Low stock and high demand are keeping auction clearance rates high and private treaty metrics tight. Auction clearance rates have held in the mid to high 70% range throughout May, fading a little from March when clearance rates were consistently finalising above the 80% mark. Despite this slightly softer result, May clearance rates were still above the decade average of 64%. Median time on market remains around its record low of 25 days, while vendor discounting rates are also around record lows. The typical discount from original asking prices was recorded at negative 2.7% over the past 3 months. Sydney's housing market has risen through the growth tables to once again become one of Australia's strongest housing markets. Dwelling values were up 3% in May, while the growth rate over the past 3 months reached 9.3%. That's the fastest growth rate over a 3-month period since 1988. The rate of growth remains higher for houses compared with units, with house values up 11% over the rolling quarter, while unit values were 5.3% higher. Similarly, we're seeing growth conditions skewed towards the more expensive end of Sydney's housing market, with the upper quartile recording a 12% lift in value over the past 3 months, compared with a 5.2% increase across the lower quartile. Overall, Australia's housing market remains firmly entrenched in a housing boom across most regions of the country. The reduction in federal government fiscal support seems to have had very little to no impact on housing demand or growth in home values to date. While future COVID outbreaks present both a health risk and an economic risk, the strong recovery in the labour market has likely mitigated the impact of removing the JobKeeper program. We are expecting housing values will continue to rise throughout 2021 and into 2022, albeit at a gradually slower pace. Domestic demand should continue to be supported by the expectation that mortgage rates will remain at their record lows for some time, as well as the ongoing high levels of consumer confidence as the economy expands at a faster than average pace. A slowdown in dwelling price appreciation is expected as affordability constraints progressively impact on market participation and potentially tighter credit policies loom further down the track. Messaging from the Reserve Bank has indicated they'll be watching for any signs of a deterioration in credit standards that could be a trigger for tighter lending rules. Worsening affordability pressures are likely to impact first home buyers more than other segments of the market, and there are already signs that first home buyer demand is pulling back. Investors, on the other hand, are stepping up their activity across the housing market, motivated by prospects for continued capital gains and low interest rates. The resurgence of investor participation and high levels of activity in the owner-occupier non-first home buyer segment may account for the continued strength in dwelling markets despite affordability constraints. Over the medium term, a rise in housing supply, together with the demand-side impact of closed international borders, is likely to be another factor that weighs on price appreciation. House approvals are moving through record highs, but it will take some time for these approvals to transition through the construction phase to a completed dwelling. Clearly, there is plenty to keep an eye on between updates. You can stay in tune with housing market news and research at our website www.corelogic.com.au.